Ladies and gentlemen, imagine waking up to a market where the pressure has been building for years, quietly, silently, until suddenly the tension snaps. Headlines begin to whisper that silver shorts are being raided, that massive positions are under stress, that forces far beyond everyday investors are shifting the balance. At the same time, another headline emerges: China tightening control over financial speculation, while regulators in the United States appear to be standing still. When two massive economic forces move in opposite directions like this, the global market doesn't simply react, it trembles. Because moments like these remind us of something powerful about financial history. The biggest shifts rarely happen when everyone is paying attention. They happen when pressure builds behind the scenes, when systems become stretched, and when one unexpected change sends a ripple through everything connected to it. Now think about the title we're exploring today: Silver Shorts Raided, China Cracking Down, and Regulators Seemingly Doing Nothing. Whether you're new to following precious metals or you've watched the market for years, this combination of forces raises fascinating questions about how modern financial systems work. It also highlights something deeper about markets. They are not just numbers on a screen. They are ecosystems of psychology, power, policy, and global competition. Silver itself has always been a fascinating asset. For thousands of years, it has served as money, technology, metal, and a store of value during uncertain times. But in modern markets, silver is also heavily traded through paper contracts, futures, derivatives, and leveraged positions. These tools allow traders to bet on the price going up or going down. And when a large number of traders bet on prices falling, those are known as short positions. Under normal conditions, short positions are simply part of market balance. They provide liquidity and allow traders to hedge risk. But history shows that when short positions become crowded, something unusual can happen. If the price begins moving upward unexpectedly, those traders who bet on lower prices suddenly face pressure to close their positions. When that happens, the result can look almost like a chain reaction. Imagine a room full of dominoes. Each one stands steady as long as nothing touches it. But once the first domino falls, the entire structure begins moving faster and faster. In financial markets, short covering can create a similar effect. Traders who need to close losing positions buy back contracts, which can push prices higher, which then forces more traders to close positions. The cycle feeds on itself. This is why headlines about short raids or short squeezes capture so much attention. They represent moments where market structure itself becomes the story. But the situation becomes even more intriguing when global policy enters the picture. In recent years, China has become increasingly active in regulating commodity speculation within its own markets. Authorities there have occasionally stepped in to reduce volatility, limit leverage, or control trading activity when they believe speculation is overheating. Their goal is often stability, preventing sudden spikes that could disrupt industrial supply chains or economic planning. When a major economic power signals tighter oversight, traders everywhere take notice. Because commodities like silver are global, supply chains stretch across continents, mining operations, industrial demand, and financial trading all intersect. When one major player adjusts its rules, the ripple travels through exchanges, institutions, and investors worldwide. Now contrast that with the other side of the headline, the perception that regulators elsewhere are not intervening with the same intensity. Whether that perception is fully accurate or simply part of market narrative, it highlights an important truth. Markets are shaped not only by economics, but also by expectations of oversight. Traders constantly ask themselves, who is watching the system and how will they respond? If market participants believe oversight is strict, behavior often becomes cautious. If they believe oversight is passive, risk-taking can increase. These psychological signals can influence how aggressively positions are built, unwound, or defended. And this leads us to the first major insight hidden within this story. Markets move not only because of supply and demand, but because of confidence and perception. Confidence in rules, confidence in transparency, confidence that the playing field is balanced. Whenever those perceptions shift, even slightly, the ripple can travel across billions of dollars in trading activity. Another layer of this story involves the nature of leverage. Modern financial markets allow enormous positions to be built with relatively small amounts of capital. This leverage amplifies both gains and losses. It also means that sudden price movements can trigger forced liquidations when margin requirements are breached. Think of leverage like a powerful engine in a racing car. It can accelerate performance dramatically, but it also makes the system more sensitive to small mistakes. A tiny shift in direction at high speed can have massive consequences. When traders operate with high leverage in a crowded position, the market becomes fragile. And fragility in financial systems often reveals itself during moments of stress. This doesn't mean every dramatic headline results in a historic shift. Many times markets absorb the shock and stabilize, but the underlying lesson remains valuable for anyone observing markets. Concentration and leverage create vulnerability. Understanding that dynamic is one of the most powerful forms of financial education. Another interesting element of this narrative is the way information spreads in the digital age. Years ago, discussions about short positioning or regulatory oversight might have been limited to professional trading floors or academic reports. Today, millions of individuals around the world analyze charts, read data releases, and discuss market structure online. The democratization of information has changed the market landscape. It means narratives form faster, ideas spread faster, and awareness about market mechanics grows among everyday observers. This is why conversations around silver, commodities, and financial structure often carry such passionate debate. They represent more than just price movement. They represent curiosity about how the global financial machine actually works. And when people begin asking deeper questions, something powerful happens. Financial literacy expands. Instead of reacting emotionally to headlines, informed observers begin studying patterns. They analyze open interest data. They look at supply chains, industrial demand, and historical cycles. They begin to recognize that markets operate through complex interactions rather than simple cause and effect. This shift from reaction to understanding is one of the most valuable transformations a person can experience when studying economics. Because markets are not simply about predicting the next move, they are about understanding the forces shaping the world. Silver itself sits at the crossroads of several of those forces. It is both a precious metal and an industrial metal. It appears in solar panels, electronics, medical technology, and advanced manufacturing. At the same time, it holds centuries of history as a form of money and wealth preservation. Few assets occupy such a unique position. That dual identity means silver often reacts to multiple economic narratives at once. Industrial demand, monetary policy, geopolitical tensions, currency fluctuations, all can influence its behavior. When traders build large positions around such an asset, the resulting dynamics can become especially complex. And this brings us to a mindset shift worth considering. Instead of viewing markets as simple battles between winners and losers, it can be helpful to see them as information systems. Every price movement reflects countless decisions, expectations, and signals interacting simultaneously. The goal for thoughtful observers is not to chase every headline. The goal is to understand the structure behind the headline. For example, when discussions emerge about short positioning in silver, one useful exercise is to explore how futures markets work. Learning about contract expiration, delivery mechanisms, and margin requirements reveals the machinery behind price discovery. Similarly, studying global regulatory approaches can reveal how different economic philosophies influence market design. Some systems prioritize stability, others prioritize liquidity and freedom of trading. Both approaches have strengths and trade-offs. Understanding these frameworks helps transform dramatic headlines into educational opportunities. Another practical insight involves emotional discipline. Financial markets are famous for generating excitement, fear, and speculation, but long-term thinkers often develop the ability to step back and observe with patience. When a story like Silver Shorts Raided begins circulating, emotions can run high. Predictions appear everywhere. Social media fills with bold claims about what will happen next. Yet history repeatedly shows that markets reward those who maintain perspective. Instead of reacting instantly, they study the data. They ask questions. They watch how events unfold over time. This patient curiosity often leads to deeper understanding than any single prediction ever could. And perhaps that is the most important lesson hidden within this entire conversation. Moments of tension in markets are not just about price. They are about learning how financial systems operate, learning how narratives shape behavior, learning how global policy decisions ripple through interconnected economies. Every cycle, every headline, every dramatic shift provides another chapter in the ongoing story of global finance. For those willing to observe carefully, the lessons compound over time. Just as compounding works in finance, knowledge also compounds. A person who studies markets for months begins to notice patterns. After years, those patterns form a framework for interpreting events with clarity rather than confusion. And that clarity becomes incredibly valuable in a world overflowing with information. So as conversations continue about silver shorts, regulatory responses, and global market tensions, the most powerful takeaway is not speculation. It is awareness. Awareness of structure, awareness of risk, awareness of how economic systems evolve. Because the individuals who thrive intellectually in complex markets are not the loudest voices or the boldest predictors. They are the ones who remain curious, disciplined, and committed to learning. And in many ways, that mindset is more valuable than any single trade or investment idea. Markets will always rise and fall. Headlines will always appear dramatic. Narratives will always compete for attention. But knowledge, carefully built over time, remains one of the most resilient forms of wealth a person can develop. So if today's discussion sparked your curiosity about silver markets, global finance, or the hidden mechanics of trading systems, take that curiosity further. Study the history of commodities, explore how futures exchanges operate, learn how global policy decisions influence economic behavior. The more you understand, the clearer the bigger picture becomes. And as always, if you found value in this conversation, make sure to support the channel by liking the video, sharing your thoughts in the comments, and subscribing for more deep discussions about markets, financial awareness, and the forces shaping the global economy. Because the more we explore these topics together, the more prepared we become to navigate a world where economics, policy, and opportunity are constantly evolving.